Next up is a question from Harley. How do you calculate effective income tax rate? Also, at what effective tax rate would you consider pre-tax over Roth for a 25-year-old married couple?
Man, okay, so we get a lot of questions about this, right? Because look, I'm going to say it. Our tax code's not the easiest in the world to figure out. Like, it's fairly complicated. There's like a gazillion pages in it, and it doesn't often like pass a lot of common sense. Like, it doesn't make a lot of sense. And so we hear these terms out there: your marginal tax rate, your effective tax rate, your federal tax rate, your state tax rate. And we talk about how to know when you go pre-tax or Roth. Well, there's some vocabulary that we should probably walk through. I'm gonna go through the first two real quick, and I'll leave some in there for you. Your effective tax rate is when you look at the total tax that you pay and you look at your income, it's the percentage that you paid. It is some combination of the blended rates as you run through our progressive tax system. It is very helpful in telling you essentially what percentage of your pay you're paying in income tax. From a planning standpoint, not incredibly helpful, because most of the decisions we make when it comes to financial planning are made on the margin. They're made with our next dollar. So what you really want to focus on, Harley, is not your effective tax rate. You want to focus on your marginal tax rate. What is the next dollar that I will be taxed at? Because that's the one that matters. If you're in the 22% federal tax bracket, you've already worked through the lower tax bracket. So the next dollar of income you have coming in is going to be taxed at 22%, or the next dollar that you defer will save 22%. So when it comes to planning, I would argue that the marginal rate is the one that you want to focus on, not the effective rate. Okay, how do I do that? Go look at last year's tax return, look at your taxable income line, go pull a tax table, see where your taxable income falls. That's how you actually find your marginal tax rate. It's not like the easiest thing in the world to do if you're not super comfortable with a tax return. It's really difficult to do if you're just a gross income earner, right? Like, you can kind of figure it out, but once you have deductions and that kind of stuff in there, it makes it a little harder. When it comes to making financial decisions, Brian, like pre-tax versus Roth, which ones do we look at, and how do we know where to fall on the spectrum?
Now, look, there's a lot that goes into this. I feel like I have to give that disclaimer because, a young person, when you have 30, 40 years of compounding growth, even if you're in a higher tax bracket, maybe sometimes it makes sense to have some of the Roth. Also, I'll put it on the bookend or donut hole in the fact that sometimes a 65-year-old, we have a brilliant client that's in a higher tax bracket. They're doing Roth too. Just because they want the estate planning opportunity of building more money that's growing tax-free. So they're okay paying more taxes currently. So it's one of those things where, you have to take this to your personal situation. Neither one of those things I just described were wrong, but we still like to give general guidelines so that somebody who's doing their due diligence and research for what's their situation, what's some things you can at least think about. So I had a case where I was recently for a client looking, and their income put them squarely in the 24% marginal tax bracket. That was their federal marginal rate, but that's not where taxes stop. We also know a lot of states also charge a tax rate, so you'll have to go figure out what the marginal rate is for the state. So this client lived in a state where they were being charged 5.3%. So if you add those two together, that is 29.3%. A marginal tax rate that the next dollar was going to be taxed, almost 30%. Well, we've always given the guidance that, look, somebody who's in a marginal tax bracket, if you add your federal and your state obligation below 25%, historically, with all the obligations of our federal government and everything else, that seems like you're not going to get a better deal than that. So if it lines up, you're young enough to where you can have opportunities for exponential growth, and your tax rate's low enough, that's a pretty good indicator that maybe Roth accounts are good for you. Because you're going to have the opportunity to let assets grow tax-free, and paying the taxes now is not the worst thing in the world. Between 25 to 30%, kind of the gray zone for us. So this client even fell into that because, 30%, that's pretty good from a historical standpoint. I love the tax-free growth. So that's probably, if you're young enough, probably going to want to do Roth on that. But if you're older and you're worried about taxes, maybe you don't. Because you're hoping that down the road when you retire and you lose your earned income and your wages, If you've done the right 3-bucket strategy where you have tax-free, after-tax, and tax-deferred, hopefully your tax rates will go down in retirement, and that will even create some opportunities to do some Roth conversions. So that's in that gray zone. 30% and greater, we kind of like, once again, this is something where you really ought to look long and hard. Do you have that mindset that taxes will be lower in retirement? You're having to take some guessing on that. We don't know what tax policy could change from Congress. But looking at all the things, the variables that do you think that your taxes paid in retirement will go lower? And do you have enough time? Because realize they've also put required minimum distributions have been expanded now to 75 for most people, or will be 75, but most people it's going to be around the 75. That gives you more time. So even if you retire at 60, there's going to be a 15-year period where potentially your income has the opportunity to be lower than your earned income wages, and then you could use that to do Roth conversion. So it doesn't. This all comes into play. That's why I always say, building wealth, it's so simple. Doesn't mean it's easy, but it is so simple that I want you to structure it to that inevitable wealth building, remove the friction, create an automatic plan that actually builds that wealth for you. But I know without a doubt, as you have success, you'll need somebody like us, because these are the type of equations we work with clients all the time. But when you're younger and you're starting out on the journey, let this be an important thing that you check the box on, but don't let it be the noise that keeps you from actually saving and investing. Because when you're young, that's actually even more important than even getting into some of these complex issues, because it's just not the time or place yet.